Can we complete the sweep on the S&P? Four-day winning streak on the S&P 500. Monday, Tuesday, Wednesday, Thursday. Can it be a move higher on Friday? Equity futures slightly positive by 0.15%. The data this week better than expected. Inflation a bit softer. Earnings so far so good. There's the opening bell. Switch of the board and get to the bond market. Stocks rallying this week. The bond market rallying too. Treasuries advancing, yields lower. That's the theme of the week so far. On the session, up by a couple of basis points. Your 10-year, 378.90 on the week so far, down 27 basis points over the last 5 sessions. Into the FX market, the euro just about positive for a 7th consecutive session. Equities up, treasuries better, yields lower, dollar a whole lot weaker this week. Euro dollar 112.28. Crude negative 0.4%. We're down to about $76.60. Into the session we go. About 30 seconds in, we're positive by 0.2% on the S&P. On the Nasdaq, up by around about the same amount, by 0.2% as well. One sector to watch at the open, the financials. JP Morgan, Wow, Citi, all topping revenue estimates as a result of higher interest rates. Abby has more. Abby.
Hey, John, and yeah, very nice quarter for these banks, and we have the stocks popping as a result. Better than feared for sure, because there had been some expectation going into this quarter that there could be a real issue around interest expense, but that simply didn't turn out to be the case. As you mentioned, topping estimates for each of these companies relative to sales. For JP Morgan, record revenues of $41.3 billion, their net interest income at an all-time high, and those rising rates helping, not hurting as had been feared. Wells Fargo also net interest income strong. They lifted that guide. The deposit costs up more than 1%, but still the stock is higher. And Citigroup, the second biggest credit card provider, well, an 11% jump on personal spending. The FIC trading solid. The big question here, John, is on the year, these stocks are underperforming the S&P 500 by, into today, by 7 to 10%, so not minor underperformance. Were these quarters good enough to provide a rotation into the financials?
Abby, thank you. We've talked a lot on this program over the last few days about the soft landing hopes and dreams fueled by the economic data recently. Plenty of Fed speak out there. Austin Goolsbee of the Chicago Fed, a dovish member of the committee right now, saying this: there is a path to curb inflation without recession. That's what the bulls are hoping for. That's what the likes of Jay Pelosky, Andrew Slimmon so far this year at least, are looking for. Let's get back to the banks. JP Morgan, Q2 results. Jamie Dimon just about wrapping up the earnings call. Shonali, you've been listening to that. What's he have to say?
Listen, they give you a word of caution for the economic environment, but so far so good when it comes to the consumer. Not just a record quarter, but a record year with net interest income. I want to flow through across the banks, though, because we've been talking so much about the good news. It's worth pointing out what the bad news is ahead. That is worries still about commercial real estate. Wells Fargo's call coming up at 10 o'clock. Goldman's earnings next week, according to Semaphore, is about to have $2 billion worth of write-downs tied to both green sky loans as well as commercial real estate. So we'll see some pictures there about what that could look like. Wells Fargo also raising its expectations for expenses, partially tied to severance, and Citigroup's expenses also coming in above line for expectations here. But all in all, people are happy with the lending. That is all the green you're seeing on the screen here, John. Even though charge-offs are going up just a little bit, you have the biggest of the big benefiting from people taking out loans on their credit cards. But again, that is not the case if you're not the biggest of the big, and I think that will be the big story going into next week.
Anything to point to this morning, Shonali, just in the way that these stocks are trading? I know it's super early days and perhaps unfair to ask this question, but the gains in JP were a little bit firmer earlier on. They're just about sticking right now, and Citi's turned negative.
Well, because when you're buying the stocks, you're buying into long term, aren't you? And to the point here is, like, a lot of these stocks that you're seeing on the screen have been up anyways on the year. Citigroup has been trading at about half of its book value, so they had the most upside because they were the most sold off over a longer period of time. But listen, what these executives are addressing right now, JP Morgan, Citigroup, is that tighter regulation, which is that longer term overhang, both in terms of capital return as well as returns on equity, as well as losing business. As JP Morgan's Jamie Dimon puts it, the private equity guys are dancing in the streets.
Shonali, thank you.
Is moving.
Looking forward to your coverage over the next week or so. Shonali working hard as bank earnings kick off on Wall Street. Plenty of commentary from the analyst community this morning, including from Oppenheimer's Chris Kotowski, who had this to say: the key takeaway from JP Morgan's print should be that all the fears about deposit beta swallowing up all the benefits of rising rates was way overblown. Oppenheimer reiterating its outperform rating following those results. That stock is up by around about 1%. That's Chris Kotowski of Oppenheimer. Earlier today we caught up with Gerard Cassidy of RBC. This is what he had to say.
If we hit a hard landing, it's going to be very difficult for the banks, including J.P. Morgan, but that doesn't appear to be the case, at least today.
Joining us now, David George. David, wonderful to do this with you around the opening bell as always. I want to go back to the work of Oppenheimer, if I may. When Chris Kotowski said this, the key takeaway from JP Morgan's print should be that all the fears about deposit betas swallowing up all the benefits of rising rates was way overblown. David, do you agree?
Yeah, I think that's right. In addition to some of the issues around deposits, I just think that it's important to understand that a lot of these banks, particularly the large ones, have significant earnings ability and flexibility to absorb higher credit costs. JP Morgan, for all of the negativity around financials, they made $14 billion, John, in 3 months. So again, they're a very resilient system, and I think the numbers this morning corroborate that for sure.
We often focus on net interest income, net interest margins. Are there reasons to believe that those metrics get better or worse in the months to come?
Well, I think one of the keys for NIM going forward is I think over the next quarter or two, particularly for the regionals, we hopefully will start to find a bottom and start to find an inflection point with respect to funding costs and some of the funding competition that's been really front and center for the bank group. And I think if the Fed is close to being done and potentially starts to hint at a cut, I think that will really be probably a meaningful positive catalyst for these stocks as we go through the balance of 2023.
Credit quality was another issue, a dimension of these earnings that many people were focused on. We did see some provisions for loan losses start to get built up again over at JP Morgan, in fact, in a bigger way than expected. David, is that something to worry about, something that concerns you?
No, it's not. I think clearly credit cannot get any better. We have come off significant stimulus, significant actions on the part of both policymakers in Washington as well as from the Fed. And that is we've had very low credit costs for a very long time, and costs have to go up. The good news is, John, we think in large part that credit costs are going to be pretty manageable, and that we are just expecting a more normal credit environment in 2023 and 2024. And fortunately, we think expectations are grounded enough that the company should be able to hit that bar, if not jump over it over the quarters to come.
Well, that has big implications for how these stocks trade, so let's talk about that. David, because of the events of the last few months, the regulatory backdrop obviously is getting a little bit louder. Does that put a lid on the potential for these multiples, the valuations of these companies, to get better?
I don't think so. I think at the large end, they're already highly regulated. So I think at the money center area, I don't think there's going to be a meaningful change in regulatory backdrop. I do think as you go down the asset size spectrum, Jonathan, you'll see more regulation among like the 100 billion in assets to 250, and that's going to be centered, we think, largely around liquidity. We also think there'll be some capital adjustments as it relates to incorporating these bond market or mortgage-backed security losses that have been kind of a near-term mark-to-market challenge. But in large part, where valuations are, particularly for the regional banks, we think expectations are extremely low. Sentiment is very negative, and the risk-reward trade-off, even despite a nice move over the last several weeks for most of the banks, is very constructive in our opinion.
David, I know you've got to run to get back on the phone and talk to clients. Just one further question. Top pick right now.
Yes,
what
sir.
is it?
Our favorite here is Comerica. It's a regional bank based in Dallas. The stock trades at just around 6 times earnings. We think it's an excellent risk-reward trade-off, and the stock has, we think, 60 to 80% upside from current prices.
We'll talk about the regionals over the next week as well. David, thank you. Appreciate it as always.
Thanks,
Let's try and catch up again over the next week. David George there of Baird on the latest from the financials. Sticking with the financials, RBC's Lori Calvasina upgrading the sector, saying this: it's driven by our optimistic performance outlook and the indication that valuations are attractive. Dividend yields are compelling, and earnings and sales revisions have shown some signs of improvement. Laurie, I'm pleased to say, joined us right now. Laurie, upgrade to the outlook on earnings from you overnight, on the sector, on the financials. Do you like what you hear this morning?
I certainly like the headlines so far. I haven't managed to catch up with Gerard yet, but we did recently do a survey of all of our analysts heading into this reporting season, not just in the U.S., but across the globe, and we found that our financials team was really resolute in terms of their optimism, and maybe, a slightly more neutral, view from our regional banks team, but even there, when I told them I wanted to upgrade the sector, they said they thought this was going to be the right call, if we could sort of get past this quarter, and we're looking on a 6 to 12 month view. So we think on balance, when we're coming up with these positioning calls, we're really looking for relative opportunity. And I think some of the comments that were just made by your previous guest talking about fears are overblown, that is often how these things get started. We actually saw tech really benefit from the idea that fears in that space were overblown. We started to see earnings revisions turn around. We're at a similar point now in the regional banks and the small cap financials that tech was a couple quarters ago when the earnings sentiment was just really, really terrible and had nowhere to go but up.
So, Laurie, let's build on these estimate changes you've made. Given everything you've just said, are you anticipating this to play out then in a broader equity market rally? Opportunities elsewhere? Does it come through at the index level at all? Did you change that call overnight?
So we haven't changed our target on the S&P. We're still at 4250. That's our base case. And frankly, it's the median between sort of 3 bearish scenarios and 3 more bullish scenarios. And that's been really the tension in our forecast all year, is that our more cross-asset driven models looking at bonds versus stocks are arguing for caution, and many of the equity-only focused indicators are much more optimistic. Now, what I see when I look at the sector performance, things like growth versus value, small versus large, we're starting to see things like the growth trade stalling relative to value. If you just do a relative ratio, small is starting to break out a little bit versus large cap. I still like my tech stocks, but I think this market is telling me in terms of the performance recently that it is ready to rotate. Now, what happens in terms of overall index performance, if you get that rotation away from these big mega caps back towards value and cyclicality, that might not result in a rip-roaring S&P 500 kind of move, but I think that you can have that kind of rotation without any kind of big damage to the S&P.
So far this year, and it's been quite a run, the tech level story has just been amazing. The dominance of some big names on the S&P. Laurie, it's reminded some people of the pre-pandemic world, and they're wondering whether we go back to that. Low growth, lower inflation, low interest rates, and secular themes dominating in the absence of all of the above. Now, Laurie, do you push back against that?
Well, look, I'll tell you, it's something that I struggle with quite a bit. You know, I look tactically at growth. I see these indications that it's stalling. Growth looks expensive versus value again, similar to recent peaks that we've had in, the past 5 or 6 years. If we look at the CFTC positioning on NASDAQ futures positioning, growth looks a little bit crowded. But if you think and kind of step back to what we're going through economically, it's either going to be a short, shallow, or skipped recession. What is the consequence of that going to be economically? I feel like at least for the next couple years, it's still going to push us into a sluggish economic growth environment. And the forecast for the next few years, if you check the Bloomberg consensus, are for sub 2% GDP in both 24 and 25. Well, guess what? Growth stocks typically do well in that environment. And to your point, that's what we experienced really between the GFC and the pandemic. So I have some sympathy for, the kind of swelling and the ballooning of those parts of the market, because growth is where you want to be if you think economic growth is going to be sluggish. Tactically, though, it may be time to take a little bit of a breather.
So just in terms of this broadening out, this is a tactical call. It's not a long-term 1 year, 2 year trade.
I think in terms of, when I talk about financials, right, is it necessarily going to be the sector I want to be in over the next 5 years? I'm not so sure that I'm convinced of that, but I do, especially when I look at my small cap earnings revision indicator. It's one of these charts that's typically, sort of hold your nose and buy. Nobody's taking numbers up. Everybody's taking numbers down. We saw that with the semis last summer, and look what's happened there. So, I feel like I don't know if it's going to happen this quarter, but I feel like over the next 6 to 12 months, we're going to have a really nice trade. But over the longer term, I have a lot of sympathy, for people who are talking about things like AI, who are talking about things like reshoring, who want to be invested in those secular growth themes, because I do think that is sort of justified on the longer term economic view for now.
Laurie, everyone who knows me knows that I read Barron's on a Saturday morning, and this weekend you were in it. It was a fantastic conversation. I actually got around to reading it eventually later on in the week, this week. Laurie, in that you talked about the restorative element of the 1940s and coming out of the Second World War. Can you breathe some life back into that conversation and help me understand how that plays into everything you've just told me?
So, the way that analysis came out, John, is I was talking to one investor after another in the first half of this year, really kind of 1Q, early 2Q. And I would take people through my sentiment model, which was very bullish, my valuation and earnings work, which was very bullish, and a couple other things. And people would be like, okay, fine, but we've never priced in the recession before it's actually started. The market's never bottomed before the recession's even gotten underway. And so we actually told people, if you look back at 1945, there was one period where the market never priced in a recession at all. And the reason the stock market didn't price in the recession was because it was technical in nature. You had a big drawdown in GDP because you had a drawdown in government spending, but you had this pivot from sort of this wartime economy, which was, very unusual, had to be propped up, by massive government support through the war effort. And we were transitioning back to a normal economy. But in general, what World War II did and what all that government spending did and all the things that happened there was it really pulled us out of that Great Depression funk. And if you looked at the GDP stats, they were pretty scary in 1945. But if you looked at things like consumption and private investment, they were pretty healthy. We had a little bit of an uptick in unemployment. It didn't really go that far. I think it topped out a little over 4%. So in general, the economy was still pretty healthy. And the market was, pretty mature about it and said, okay, we can look through this technical recession and just march on through and trade on the fact that the underlying economy is still in pretty good shape. And I think that's really what equity markets have done this year as well.
I enjoyed the interview, enjoyed this conversation too. Laurie, always wonderful to catch up with you. Laurie Calvasina there of RBC, upgrading the outlook for earnings and looking for a move towards the financials. Seeing some of that develop in the last few hours off the back of earnings from JP Morgan and the likes of Wells Fargo. The S&P just about positive by 0.2%. It's a fifth consecutive day of gains, Monday through Friday. We'll see about the Friday bit. Coming up, President Biden wrapping up his NATO victory lap.
The American people known since the end of World War II and the formation of NATO that our security rests in the unanimity among European and transatlantic partners, us. The world is watching to see, will we do the hard work that matters to forge a better future?
That conversation up next.
American people known since the end of World War II and the formation of NATO that our security rests in the unanimity among European and transatlantic partners, us. Will we stand together? Will we stand with one another? Will we stay committed to our course? This week, Finland, the United States, and our allies and partners said a resounding loud yes.
President Biden touting a productive NATO summit. Finland officially joining the alliance. Sweden on the path to membership, and Ukraine remaining a top priority. The president saying, quote, "The one thing Zelensky understands is that whether or not he's in NATO now is not relevant, as long as he has the commitments that guarantee his security." The president now back in Washington, D.C., alongside Bloomberg's Anne-Marie. AMH, walk us through what for many people might describe as a decent week for this White House.
Yeah, it was a decent week. One, John, you, of course, been covering on the economic front the cooling of inflation data that Biden says is Bidenomics at work. But obviously on the foreign policy front, the president really wants this to be front of mind for American voters, not just that he was able to keep NATO united amongst Russia's aggression in Ukraine, but that it was able to expand with giving this path forward via Turkey for Sweden to join the alliance. That was done on this trip, as well as really a U-turn from President Volodymyr Zelensky, which went into the NATO meeting very angry, and that tone really shifted to one of appreciation for the group and for the American president. But for this president, really what he was trying to convey was to American voters the contrast he can be as a foreign policy hand versus his predecessor, who also happens to be the front runner who will be running against him potentially in 2024. Because, John, he went back to the exact same presidential palace to give his press conference, and that was where the former president said that he believed President Putin when he sat down with him when it came to the 2016 election meddling, not his own intel. So the president made two really important remarks there. President Biden said that, one, Russia did meddle in our elections, and then secondly, he said that he can guarantee that Finland will be safe in NATO. And this is something that the former president used to go to NATO meetings and really try to rile them up and say that the U.S. would leave NATO if other members didn't reach their 2% spending target.
Well, let's talk about that 2% spending target. The former president complained, and many people assumed he was correct to. Anne-Marie, has the current president got those commitments from other members of NATO to actually fulfill what they agreed to?
Well, what we've seen out of this meeting is that the 2% target is now going to be the floor. It used to be almost aspirational, trying to get all of these members to hit 2%. Now it is the floor. You have to hit 2%. This is going to be difficult for some countries like Canada, Italy, Luxembourg, which are not there yet. But this is something that the group is really trying to work towards. And there has been pressure from the United States via the former president and also this president. I think when you talk to other members, foreign leaders, Jonathan, and their teams, what they'll say is just a lot of it is a lot of the same pressure and policy. It's just the rhetoric around it and maybe the bedside manners.
Anne-Marie, thank you. Wonderful work over in Lithuania. AMH emailed me about 3 minutes ago, said I thought Saturday was for Premier League football. It is, and Barron's and, of course, Premier League football's taken a break. MH, thanks for that. Let's get you some sector price action. Equities doing better this week, Abby. What do you got?
Yeah, they certainly are, John. We have the S&P 500 now up for a fifth day in a row, the first time we have seen that in about a month or so. Most sectors on the day are higher, not surprisingly. Well, it's interesting because healthcare is actually the highest. I was going to say, not surprisingly, financials up on top. They are higher, but underperforming the best sectors. On bottom, energy, utilities, materials. Let's take a look at that healthcare sector because so much attention going to banks on earnings, but we also have United Health absolutely soaring. They put up a better than feared quarter, and that is helping out some of the other healthcare indexes. So here's the defensive sector that is taking charge on this Friday, John.
Abby, thank you. Coming up next, your trading diary. 26 minutes into the session, on course for the longest winning streak in around about a month. 5 days of gains on the S&P 500. Let's see if this sticks. We advanced by 0.3%. That's the price action. Here's the trading diary. Top of the hour. You missed consumer sentiment. Big bank earnings continue next week. B of A, Morgan Stanley Tuesday, Goldman on Wednesday, Tesla and Netflix as well. We round out the week with regional bank earnings too. From New York City, we round out this week for me. Thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. Have a wonderful weekend. This was the countdown to the open. This is Bloomberg.
Great questions. From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Friday, July 14th. We made it. Here are the top market stories we're following for you at this hour. How you feeling? Latest University of Michigan sentiment dropping right now. We're going to have instant analysis with Joanne Shu, University of Michigan Surveys of Consumers Director. And banks feel pretty good, mostly. JP Morgan, Citi, Wells beat estimates, lots of wins. You got revenue to net income to return on equity. And the dollar, though, feels sad. The dollar has its worst week since November. We see if earnings support the everything but the dollar rally and a Goldilocks economy. From New York, I'm Alex Steele with Danny Berger over in London. Guy Johnson is off today. Welcome to Bloomberg Markets. Danny, pleasure to have you. Quite a big week for global equities and a really negative one for the dollar.
Yeah, a really negative one for the dollar. Everything is basically rising against the dollar this week. It's coming in a little bit. That narrative is changing. Dollar is stronger, and we're getting UMich numbers now, Alex.
Yes, maybe that's what's also helping to lead here. You're seeing the front end sell off. UMich sentiment jumping to 72.6. The current condition index jumping to 77.5. Expectations jumping to 69.4. One-year inflation expectations also rises. So does the 5 to 10-year inflation. But nonetheless, the sentiment, the highest in September of 2021. So as we said, how are you feeling, Danny? The consumer, as of now, from this survey for July, feels really good.
So good. I mean, this is a massive beat from expectations. 65.5 was the expectation. The sentiment is at 72.6. Let's get instant analysis on it with Joanne Shu, University of Michigan Surveys of Consumers Director. Joanne, I mean, this is a really confident consumer. What do you make of it?
Indeed, this is the second straight month of huge increases in sentiment for consumers, and they're just really on the upswing right now. They're feeling much better than they were last year, and it's very much being supported by the continued slowdown in inflation as well as continued strength in labor markets.
So, but you also saw inflation expectations move higher for the 1 year, and I feel like normally when that moves up, sentiment falls over. So why can both move higher and everything's okay?
The reason is that it only ticked up just a little bit. It only went from 3.3 to 3.4%. It was a very, very small change, and it's much lower than it was a year ago where it was over 5%. And the 5 to 10 year long run expectations have been sticking within 2.9 to 3.1% for 2 years now, and that continued this month.
Joanne, is there some degree with which consumers are getting better at understanding inflation and handling inflation? They're kind of living with it more now?
That's certainly part of the situation. They're not nearly as in shock as they were when the situation started a year and a half, 2 years ago. But the thing is that consumers were feeling a lot of anxiety and uncertainty over the trajectory in inflation. And consumers are feeling considerably more confident now that they have a better handle that inflation really is slowing down. The uncertainty over their expectations has come down considerably over the course of this year.
We've just seen global stocks have the best week and the best rally since November. How's the stock move at all playing into this?
It's playing into it a little bit, particularly for higher income consumers. For them, they are feeling stronger about their assets, and certainly higher income consumers are being supported by the strong performance in stock markets. For lower income consumers, they're not really being affected at all, and in fact, their sentiment went down a bit this month.
Interesting.
Joanna, we have seen oil prices perk up a bit. They perked up this week pretty significantly given some specific oil market dynamics. But how sensitive is what you see the consumer to oil prices? If we do indeed get a resurgence in the cost of energy, could that really shift the picture?
It depends on how sustained any increase and how much this increase in gas prices might be. If it lasts, and particularly if it's coupled with a turnaround and an increase in inflation again and other prices, it really could put a damper on consumer views. But if overall core inflation continues to slow down and cool down, a slight increase in gas prices probably is not going to turn the tide.
Hey, Joanne, can you go back to what you said about the lower income customers versus the higher and the divergence between the two? What's driving that?
I think very much it's the stock market. Generally, higher income consumers always have higher levels of sentiment than lower income consumers, but actually they converged last year with the turbulence in the stock market and inflation hitting everyone. Now the stock market is picking up again. People who hold risky assets are feeling more confident about that, and the historical divergence that we see it has come back.
Do you see a divergence then not just in sentiment but in inflation expectations then between the two different groups?
A little bit, but not really. I would say there's quite a bit of consensus that inflation has slowed down. That's something that we see across the board, across different types of goods, durables as well as goods in general. And lower income people are feeling the hit of inflation a little bit more, but they do believe that it's slowing down.
Joanne, also what we saw in last jobs report was that for minorities like African Americans and Latina, employment started to roll. The employment rate started to tick higher. Are you seeing that uncertainty or the lack of jobs there transmitting into the survey?
We are seeing that higher income consumers, which is to some extent correlated with race, they feel more confident about labor markets. Lower wage workers are feeling less confident. I mean, they don't feel like the labor market is unraveling, but they do feel less confident about their incomes. They expect their real incomes to decline over the year ahead. So we do see a bit of that, but it's not a stark divergence.
I mean, Joanne, does this just say to you that if the Fed wanted to, they could continue to hike more without really cracking consumers?
At this point, actually, consumers are expecting interest rates to continue rising. They're not expecting interest rates to fall anytime soon. And I think that the fact that consumers feel confident about their incomes is probably a good sign, and a good sign for policymakers who are that consumers could withstand further rate increases for the time being. But of course, there are long policy lags, so it remains to be seen.
Joanne, what is, just going forward, what's the biggest question mark you think that consumers have? If they're kind of like making peace with higher interest rates, they're dealing with 7% in the 30-year mortgage, they're dealing with inflation expectations kind of hovering around 3%. What's their wild card now?
Their wild card at this point is whether or not their incomes can hold up and whether or not they can continue feeling confident about their jobs. Just a few months ago, we were starting to see some cracks in labor market expectations. Those have firmed up again, but I think that is the wild card. If labor market expectations unravel, it doesn't matter if consumers believe that inflation is coming down. They could really start feeling unconfident about the economy, unconfident about their personal circumstances.
Joanne, we love this instant analysis. Thank you so much for giving it to us. That big surprise jump in consumer confidence in the UMich report. Joanne Shu, University of Michigan Surveys of Consumers Director. And just for perspective, right, the equity market was already rallying, but now we're seeing the bond market kind of change its tune a bit. We're seeing some heavy selling pressure, particularly on the front end. You get yields up about 6-7 basis points. Danny, to your point, does this give the Fed more of a green light to keep going? We heard Waller yesterday really put September back on the table, kind of picking up that hawk mantle. And you have to wonder, like, okay, if you're feeling do you need to crack the consumer to fix the inflation problem?
Well, Goolsbee was talking just moments ago in an interview with another network, talking about this idea of we're going to have a golden path. There's a way to get inflation down without pain. But it's really hard to let go and separate the two ideas. The fact that we could have such a strong consumer and not have inflation come down, Alex.
Or is this Goldilocks? Dare I say it? Anyway, so coming up, we're going to talk about this question of the day and kind of tie it into the earnings picture as well. Will earnings this season confirm a Goldilocks economy? We're going to talk to Natalie Lavelle, UBS Global Wealth Management Senior U.S. Equity Strategist. This is Bloomberg.
earnings season is coming.
We're going to see cracks start to emerge. This earnings season could be a little bit choppy.
This is going to be an earnings season mystery.
Bloomberg breaks the numbers first.
Those earnings just crossing the wire.
Up by 25%.
Absolutely blew out of the water expectations.
With exclusive expert analysis.
We're starting to see earnings recovery emerge.
AI will be a huge boost of revenue growth.
We're not going to see the same follow-through in terms of the price reaction.
Second quarter will be where the rubber meets the road.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
What's driving it right now is that I think a lot of investors feel like we've effectively reached cruise altitude. The broad takeaway from my perspective is that investors feel like we can see the terminal rate. It's somewhere in the near future, and it's time to take that trade-off. And I think that's a big driver.
That was Matthew Rao of Nomura Private Capital speaking to me and Guy yesterday. So let's get to the question of the day and kind of pair the two big stories of the day, earnings and the economy. Will earnings confirm a Goldilocks economy that you could point to in the UMich numbers that really blew expectations out of the water? Joining us now for her take, Nadia Lavelle, UBS Global Wealth Management Senior U.S. Equity Strategist. Nadia, what do you think?
Yeah, of course, time will tell, but it does feel like the earnings season will show that the economy and the consumer are still chugging along. But I will say that, expectations are for that pace to slow. You even heard that from some of the banks on their earnings call this morning. Despite the strong earnings that we saw out of JP Morgan, they too pointed to some signs of caution ahead around the consumer and the normalization process that's happening. Consumer remains strong, yes, today. But in terms of the earnings season, we think that it's not only about earnings, Alex, it's also what you pay for those. Yes, companies are going to likely beat those lowered expectations. The consensus is looking for an 8% decline in earnings, just given the fact that we've had positive economic surprises. We are looking for 3 to 5% decline, but a lot of this seems to be already priced in. And so we just think that the market reaction is going to be more subdued. The buy-side bar is probably a lot higher. And also just the setup coming into earnings. We've had one of the strongest pre-earnings rally in about 2 years. So sentiment has improved, as we saw even in UMich this morning, and positioning also has improved. So those tailwinds have faded.
It's confusing, right? Consumers more confident. JP Morgan, as you mentioned so rightly, Nadia, sees signs that the consumer is starting to slow their spending, eat into their cash buffers. How much, though, would that need to slow to actually hurt equities? How painful does it get for the consumer? Does it need to get, or is just a slight slowdown enough?
I think it needs to be a more significant slowdown. And a lot of this hinges, as we know, to the job market. And so consumers have the confidence to spend because they are not concerned about finding another job should they get displaced. And so if you start to see some cracks in the job market, then that's probably going to lead to further slowdown in the consumer. Right now, we just think that the consumer will slow, but not to any sort of big stop that is going to send this economy in any sort of tailspin.
So Danny, will earnings confirm a Goldilocks economy? Yeah, kind of for now, ...
Yeah.
Which brings me to what Bank of America was talking about today in their report. They were looking at flows, and they said there is a capitulation risk because fast money is bullish, but slow money is still bearish. And if you get that tailwind for the slow money, you have a capitulation risk. That's a hard word to say sometimes.
Yeah, it is. Yeah, you nailed it. You nailed it. But Nadia, what do you make of that divergence that Alex was just talking about there? If you do have fast and slow money doing two different things, is that a contrarian indicator to some degree?
To some extent, but I think that the long-only money is still a bit cautious because there are signs that the economy could slow in the second half of the year. I think a lot of people are paying attention to some of the leading indicators, so ISM manufacturing, ISM services, even some of the credit card data that are pointing to some signs of caution ahead. And so we think that it's going to take a little bit longer. Of course, there's a fear of missing out just given the strong rally in the first half of the year. So you are starting to see some repositioning, particularly in favors of the cyclical areas of the market, which quite frankly, this is one of the reasons why we also upgraded in energy and still like industrials here, because we do think that the more cyclical areas of the market in the near term has an opportunity to catch up.
So would that catch up, Nadia, be on a 2024 outlook, or is the catch up just they've lagged so much in this recent rally?
they've lagged in the rally, and in terms of like being that we've seen better economic data. I mean, a lot of this has to do with just a strong outperformance of tech, right? It's not that these companies are in worse shape. It's just that there was a lot of frenzy around AI and tech, and some money cycle into that. But now you're seeing a bit of a breather in that. If you look at the performance of the last month, tech is sort of roughly in line, slightly above the market. But if you look at energy, if you look at industrials, these are the areas that are starting to outperform in the last few weeks.
Alex, what Nadia is talking about, I think, is really fair because it's this warning that didn't come true, that the market was too over-concentrated. Savita Subramanian over at Bank of America had a note out yesterday saying that, like, you shouldn't compare it to a bubble. These are 7 different companies that do 7 very different things. The fact that they're market leaders isn't necessarily a bad thing.
Well, no, and also, if it is at some point an AI trend also, that's going to have filter out to other areas of the stock market as well. Nadia, is there a point to that maybe, that like it wasn't just, a bubble, but they're individual catalysts that are really moving these guys, not to mention now the weaker dollar is going to help them?
Absolutely. I mean, we think that there is some credibility to some AI trade in the longer term. I mean, there is some exuberance in the short term. So we continue to preach that you want to be selective in some of these names, given that they've run ahead of fundamental. But longer term, we've always been talking about AI as part of our broader tech theme, even though we do have an underweight in terms of a least position on tech. It's more the fact that we just see better opportunities and better valuation in some of the other areas of the market. But longer term, there is legs to the AI story, but it will take a few years for it to play out and touch those ancillary sectors.
Nadia, today we're going to hear from the NASDAQ about exactly how they're rebalancing the NASDAQ 100 because of that over-concentration. Should we care at all? Does it matter to investors whether you're passive or you're in an active fund that is benchmarked against it? How much of a difference does it make to get that index change?
Yeah, it's important. I mean, you want to have a diversified index. I mean, if you allow, these handful of companies to overtake an index, and it doesn't offer much diversification and offer a greater risk to the market over the longer term, because if something goes wrong, given the concentration of performance, and a lot of these performance are hinging to one theme, whether it be AI or, EV, if something goes wrong there, then you'll have a market that will be down a lot, and it will be down a lot. So that's why that diversification and that rebalance needs to continue to happen as these stocks move and become a larger portion of the index.
Right, that one-way trade can get kind of scary sometimes. Nadia, really wonderful to speak with you. That's Nadia Lavelle of UBS Global Wealth Management. Still ahead, Hollywood on strike. Actors join writers on a work stoppage. We're going to bring you what media moguls gathering in Sun Valley are saying. This is Bloomberg.
It is 21 past 7 on the West Coast. We want to get to the startup where we cover the top tech stories from the Bay Area and beyond as Silicon Valley starts its morning. And for this, we're joined by Bloomberg Technology co-host Ed Ludlow. Ed is in Sun Valley, where some of the biggest names in tech and entertainment are gathered for Allen & Co.'s annual conference. And Ed, the big conversation for us in the office this morning was the actors joining the writers' strike. This is a huge shutdown of Hollywood and of the TV industry and going to have huge ripple effects. What are people talking about right now?
Yeah, they're worried because of the timing and the compounding effect that it will have on top of the writers' strike. You know, the Actors Guild's 160,000 people. They're negotiating with the body that represents the studios, Netflix, Warner Brothers, Discovery, Disney, and the CEOs of each of those companies are here in Sun Valley. So it's a difficult situation, and I think what's so interesting, we started this week asking a single question: how do the streamers in particular become profitable? And the answer in the early part of the week was, well, spend less money on content, be a bit more measured in the number of shows you're making, think about how you distribute them. Now it's like, oh, we're not going to have any shows. The writers are on strike, the actors are on strike. The content slate for rest of year next year is a bit concerning.
How does this impact those streamers versus the traditional kind of studios, Ed? Because I could see the argument being made, studios kind of save money if they're not putting out content, but the streamers, they can't afford not to put out any content. They need people to continue to subscribe to Netflix or Disney Plus or what have you.
Yeah, I mean, what's so interesting is how we measure the streamers now. There was, in 2020, 21, 2022, everything was about the subscriber level or volume. You know, Disney reaching 100 million subscribers was everything. But, you know, the competition between each of the platforms, you have to attract users that are new, and you have to keep the users you've got. And the decision that's so interesting around the Actors Guild in particular, for a lot of these, is where they release the end product. Do they simultaneously do in theatre and on stream, or just stream where they control the content distribution? And now there's a question about whether any content gets made at all over the next 18 months. So that's one area to look at.
Well, what I find puzzling is that this is a total structural shift in how people view media and how then actors and writers should get paid based on how we view media. Like, no longer can you rely on a weekly episode and then reruns and then syndication. Like, that is no longer a format that necessarily works for all content. And I'm just curious as to how executives in media are thinking about the structural change for the actors and the writers. We know how they think about it in terms of their business model.
Yeah, so this is what we've been debating here in Sun Valley. There's the model where you make your own content and you sell it directly to the consumer, a la Netflix. Disney's model is to do all of it. You make your own content, you release it exclusively on Disney Plus, but you also have other distribution channels for your movie content to go to, theaters doing deals with other linear or streaming platform-based companies, and the latter seems to be where profitability is achievable. You know, I spoke to a Disney board member earlier in the week. She threw a little bit of shade at the Netflix model. Actually, long-term, that's not the way to make money.
Interesting. And I know that's been a conversation there, but I got to be honest, has anyone really been talking about anything else besides Microsoft Activision there?
This is it. This is the big deal, and the reason is, A, all of the CEOs are here, Bobby Kotick and Satya Nadella, but also they're using it as an example, a case study of what happens with Lina Khan. Everyone here is talking about Lina Khan for obvious reasons in the FTC. And many, you know, have the opinion that this wasn't a battle or fight that she could win, that no one really accepts the argument that this would hurt competition. There's a super fixation on cloud, but actually Microsoft buying Activision was much more to do with mobile gaming. So the deadline here in the US is midnight San Francisco time tonight, unless the 9th US Circuit Court of Appeals issues a stay. The clock's ticking. I better get on a jet back to San Francisco so I can be there in time.
All right, which you will, but like 20 seconds real quick, Ed. Do they want Lina Khan gone? Like what's going to be their takeaway from this?
I think their takeaway is that if the deal goes through and the FTC is not successful in blocking it, we might start to see green shoots in M&A, you know, in TMT in particular. Remember, that's why we're here, TMT and talking about deals.
Ed, thank you so much. That is Bloomberg's Ed Ludlow, and you can catch Ed and Caroline Hyde on Bloomberg Technology in around 90 minutes time. Coming up, we're going to get a CEO's take on the strength of the U.S. economy. Jennifer Rumsey, Chief Executive Engine Manufacturer Cummins, is next on Bloomberg.
About that all day yesterday.
We're about an hour into the U.S. trading session. You have stocks on the front foot, off the lows, but that UMISH number really lit a little bit of fire under the equity market. Abigail's tracking the moves. Abigail?
Yeah, and over the last 5 days, Alex, it just seems that this bull move is in place. Even with that hotter UMISH number, this would be pretty unstoppable. At least right now, it feels that way. Up 2.7%, the best week since the end of March. And of course, the big driver for it, the idea that inflation may be closer to where the Fed needs it to be and that their hiking cycle can stop sooner rather than later. As for what's beneath the lid, one driver today for bullishness, although it's a little bit of a mixed picture at this point. If we take a look at the banks on the day, we're going to see that JP Morgan is higher, up 0.7%, well off of its, I think, 2 to 3% highs. They, of course, put up record revenue. The net interest income was also a record. Wells Fargo just slightly higher, and Citigroup solidly lower, down 1.8%, despite all these banks beating estimates. So it seems as though investors investors not quite as happy as they had been. We'll be digging into those results a little bit more. And on the year, these stocks underperforming too. So the next chart we're looking at, I don't think that it's going to hold true anymore. It actually is. What we're looking at here is in purple, the BKX, the KBW Bank Index. So regional banks in there on the year still down 17%. The XLF, though, is actually slightly higher, up 1.3%. I think JP Morgan probably really helping out there. There is the S&P 500 up nearly 18%, the NASDAQ 100 up 44%. So you can see the level of underperformance. One question today, these results came in better than expected. Would it be enough for a rotation into the banks? You know, it's hard to say. These beneath the surface, that didn't look so impressive to me, but the XLF, decent. And then finally, if we go cross-asset, let's take a look at the Bloomberg Dollar Index, getting a little bit of a bid after that big 5-day slide. Let's see if it holds. There is some important support to be taking a look at. The 2-year yield helping the dollar go higher. And then this is interesting. We have the VIX at 13.7. We have the VIX in at 20. That, of course, Alex Guy, is the NASDAQ 100 VIX, and it's a good 6 points higher, suggesting that some investors are still a little bit nervous about what could be ahead for big tech.
Yeah, that 2-year really getting pummeled by those UMich numbers. Abigail, thank you so much. Bloomberg's Abigail Doolittle there. Now, what Abigail was talking about earnings does get into our question of the day. Combining it with this economic outlook, will earnings confirm a Goldilocks economy? Let's take a look at it from the view of the real economy. Natalia Knijaevich is diving into this. Natalia, what you looking at?
So one way to look at the economy is to look at industrials, and freight market can give us a sense how demand looks like. So this chart shows truckload rates per mile, and you see that the numbers are going down. Bloomberg Intelligence expects that this trend will continue in the second half of this year. That's because higher interest rates are affecting construction and just more broadly consumer behavior. Let's flip up the board and look at another indicator. It is the demand for heavy trucks. We see that it is still resilient, but it's slowing down. Freight intelligence company FTR expects that growth for this year will be at about 3%, and starting from next year it will go down. And now, like as we see, some indicators are still strong, some are going weaker, and we will just go to the company level, and for that we will go to Cummins. This company manufactures diesel and natural gas engines, and they also do some power generated systems. So they really have strong demand, and during the last quarter they provided strong guidance. They increased full year revenue and earnings forecast, and it is of course driven by strong demand for their products. So, but the big question is, will this demand be as resilient as it is now, and will this forecast hold, as some indicators point weakness?
All right, Natalia, great setup. Really appreciate it. Natalia Knijaevich joining us there. All right, coming up now, we have CEO and Chair of Cummins, Jennifer Rumsey. Jennifer, it is such a pleasure to talk to you. What is your level of confidence in your outlook for the rest of the year as we're starting to get some conflicting signals within the economy?
Yeah, well, first, it's great to be with you today. And we continue to see quite strong demand across our markets around the world. In the first quarter, we had record revenue and earnings that we delivered, and for the year, we're guiding that we will increase revenue 15 to 20%. And there's really 3 drivers for that when you think about our revenue and what's going on more broadly. So first, it's important to remember we're coming off of 2 years where we saw a lot of supply constraints and challenges that really capped our ability to meet the demand that was out there. And during that time, our customers were using trucks, construction equipment at a very high level. So there's this pent-up demand that we're continuing to meet, and we're seeing that play out. Second, our products are performing really well for us, and we're seeing continued demand for Cummins products. And then third, we completed the acquisition of Meritor last August, and so our revenue this year reflects that full year Meritor revenue. We've seen that, we continue to watch what happens over the course of the year. The backlogs are still quite good for this year, and my team and I are watching some of the broader indicators and prepared to respond, of course, as our customer demands change. Today, I'll tell you, most of my conversations with customers are around continuing to make sure we work through those bottlenecks and meet their demands, and also talking about Cummins' destination zero strategy. So our products are performing well now, and we're also talking to them about how our industry and our business is evolving. As we
Jennifer,
face this global
if I can
climate
jump
change
in
challenge.
on that bottleneck, we'll get to some of the environmental things in just a moment, but on that bottleneck point, what is still a thorn in your side? What is still the hardest thing to source that is really just holding things up still?
Yeah, it's two things, I'd say. The persistent issue for us has been electronics, semiconductors, other electronic components, which have improved and continue to be a persistent challenge for us. And then it's a lot of smaller suppliers and continuing to have some challenges with them. And so it's not necessarily one thing day in and day out, but we're seeing periodic, less frequent but still persistent supply challenges that exist, and really trying to work with our suppliers, in particular some of the smaller suppliers, to make sure that they're addressing those issues, whether it's capacity, because we are supplying at a really high level right now. It's labor challenges or other things that they have in their supply chain.
Jennifer, what's your visibility on when that might get cleared up?
Well, right now the challenge is with very high demand, it's hard to completely clear it up. So, I hope the answer to that question is not for some time. If we do see some softening in demand, I think we'll catch up. We'll build up more inventory across the supply chain and then see that improving.
The difficulty of China's economy to recover to the pace that many people thought it would has surprised a lot of people. Jennifer, have you been surprised in terms of China's lag? And do you have any insight into whether or not that picture will change?
Yeah, really for us, China has played out about how we expected it. We saw really strong demand coming into the pandemic and early in the pandemic. Then that dropped off. There was an emissions changeover and, of course, the COVID policy there that really impacted their economy. And we projected they'd see some slow improvement in that. And we are seeing that. It's improved over last year, but still, the economy there is pretty weak, and we've not seen a lot of increase in overall demand in the market. We are seeing some improvement in our own position in the market as we've launched new products there that are performing well, and we expect that we'll see some slow recovery and improvement in China.
So let's talk about the backlog then and sort of the orders, because there's two parts to Cummins, if I just put it like that. It's sort of decarbonization with the stuff we already have, right, like making better engines, et cetera, and then there's new tech, new things, like electrolyzers, hydrogen, like a new fuel leader that can hold just hydrogen. Where's the biggest backlog that you're experiencing right now?
Yeah, so today, the demand is predominantly demand for our diesel business, and our revenue for the year, last year we were at $28 billion in revenue. So the revenue on those new products in our business Accelera by Cummins, which is really focused on these zero emissions technologies, and even on natural gas engines, it's quite small. So the demand today is really on diesel. As we move to the future, our strategy and the growth opportunity that we have as we decarbonize commercial and industrial applications, we believe will continue to provide an opportunity to grow our diesel business and the demand that we have there, as some of our customers no longer want to invest in their own diesel engines and are looking to use Cummins more. We also see an opportunity for these transition solutions like natural gas, potentially hydrogen, combustion engines, and other engine-based solutions that reduce the total carbon emissions from the product. And then we're really focused in our Accelera business on these zero emissions technologies like battery electric powertrains and fuel cells, and even electrolyzers for green hydrogen production. Those are really only viable in a few markets today. There's a lot of infrastructure to be built out. They're higher cost today. And so we're seeing early demands. Well, the place I'll tell you we're seeing the most interest and growth in the Accelera business is really in electrolyzers for hydrogen production. So that's an area that we think is going to grow a lot.
Well, with a lot of these green tech, how have you seen the divergence between American produced and staying in the country versus Europe post-introduction of the Inflation Reduction Act? We now have enough time under our belts. How has that evolved?
Yeah, it really has shifted things, to be honest. A couple of years ago, there was a big move and a lot of interest in Europe. We continue to see interest in Europe, and they're really focused on decarbonization and also addressing some of the energy challenges that they have there with things like hydrogen. U.S., though, with some of the policies that have been put in place with the infrastructure bill, and the climate provisions in the IRA is driving a lot more interest in these technologies and investments in the U.S. So hydrogen production, as an example, since the IRA was announced last August, we have invested within our Fridley, Minnesota plant on assembly of electrolyzers to meet the demand that we see here developing in the U.S. So I think it's going to be great for U.S. innovation and development in this decarbonization journey.
Jennifer, really a pleasure to speak with you today. Thanks so much for joining. Jennifer Rumsley there, CEO and Chair of Cummins. Now, coming up, U.S. earnings season is off to a strong start. JP Morgan, Citi, and Wells Fargo all out with some above expectations results. We're going to be speaking with a bank shareholder, Cole Smead of Smead Capital next. This is Bloomberg.
Citi, Wells Fargo kicking off bank earnings. They got beats. It did top a low bar. Wells Fargo's analyst call's underway. The CEO, Charlie Sharp, says it's likely there'll be continued economic slowing. CEO Jamie Dimon also sending a similar warning on this morning's call.
The headwinds are substantial and somewhat unprecedented. This war in Ukraine, oil, gas, quantitative tightening, unprecedented fiscal needs of governments, QT, which we've never experienced before. And I just think people should take a deep breath in that. And we don't know what those things are going to put us in a soft landing, a mild recession, or a hard recession. And obviously we should all hope for the best.
Joining us now, Cole Smead, Smead Capital Management President. He owns JP Morgan, Bank of America, and American Express, among many other things. So, Cole, what's your take here? At first blush, beat that low bar, yes, but some of the commentary was strong, but now it looks like the stocks have rolled over here.
Yeah, I mean, this is an unstoppable economy as we continue to talk about, Alex, and I think that's what the banks show. Is that, think of the last 2 years have really been a waiting game, waiting for this supposed recession that's coming around any given corner, and the consumer continues to outpunch expectations. If you look through the reports, you'll see that like charge-offs tied to credit cards are up, but nothing meaningful. To Jamie Dimon's point, this is a slowdown relative to the economic activity or growth that we had, but this is not a massive problem, economically speaking, tied to consumers or businesses.
Why aren't these stocks seeing more sustainable gains then, Cole? Wells Fargo and Citi have both rolled over. JP Morgan is up not even 0.2%. If this is reflecting positivity, why can't they sustain any gains?
I just don't think there's anything that's surprising expectations like we were talking about before. I think the thing the street really likes is that there's no big problem that they were exposed to in this quarter that people didn't expect. At the same time, I mean, what you really need is a pickup in lending. That's what these folks really need in their business. So, for example, look at mortgage lending. Housing has not turned over like people had predicted. At the same time, you look at the lending business, and lending business are still getting cut. So having that kind of activity pick up at a later date would be really beneficial. That could come off tighter spreads off. You look at the 30-year fixed to 10-year Treasury. That spread coming in could help that business. But in the interim, you're not taking a lot of risk in their back book, if you will, because if those homes aren't going down in prices, that means they're sitting on really nice equity for the underwritten mortgages already.
So you own JP Morgan. Twofold question: would you be buying more right now? And if not, where would you be buying? I'm looking at State Street, off 10%. I mean, getting hit really hard as net interest income declines about 2%.
Yeah, it's a good question. We really like traditional banking relative to, say, asset management. You couldn't pay me to be in the asset management world as an investor. It looks like a nightmare, Alex, where we're dealing with higher rates in so many ways. Equity market prices are not justified based on where short-term treasuries are at. I mean, if there's anything that looks odd to us out there, the short-term treasuries look like a really interesting investment relative to the stock market, relative to even the long end of the bond market. So I think the wealth management business is going to struggle because as high rates continue to ruminate on the longer end of the curve longer term, you're going to find out that wealthy people or wealthy institutions aren't as wealthy as they once were when rates were lower. And so I do think we have a keen interest in traditional banking. Beyond JP Morgan, like you said, we own Bank of America. We kind of sit in the Buffett camp on both names, where it's like we just love owning these businesses. We love being an owner. But where we've been doing a lot more of our research, we don't own anything yet, but it's been in regional banking because they're just been so much harder hit from the events of earlier this year. And then the other places, we've been more active out in our international portfolios in European banking. I mean, no one expected UniCredit, for example, to do what it's done the last year. Yeah. And they were just coming from such depressed prices that capital allocation could have a fundamental effect on the overall stock price.
Would you want to position it all for more acquisitions, for JP Morgan to get bigger, maybe even in Europe? Do you expect more consolidation anywhere?
There's going to be consolidation. There's no question about it. We're probably going to lose a third of the banks over the next 10 years, just as just thinking about that. Most of that consolidation will be on the smaller end of the capitalization structure. But you could see it go on across border basis. I think Europe, frankly, needs a lot more consolidation. That's where, return on capital is lower. I mean, you talk about, here's JP Morgan and these banks punching out mid-teens ROE. There are still banks in Europe that would die to end up with that. Where they're just now getting over 10% ROE. So I think you have to arbitrate for the different returns on capital. At the same time, if you can go buy a bank over there for 10% ROE and it's trading for half a book, that's a little different than getting 16% ROE and paying 1.6 times book. You have to kind of let those weighing mechanisms sit against each other.
Hey, Cole, I have to give you props here. You were calling the strong underlying economy for a while. Even when a guy and I thought you were nuts. You're like, nope, this is good. The economy's going to keep firing on all cylinders, and you're really betting on that. What is your favorite play on that right now? Because like the UMich that came out, lower income respondents are starting to feel more pessimistic. We have unemployment rates for minorities picking back up. How are you feeling right now?
Yeah, you're spot on in terms of thinking about how you think about the risk. To give you kind of a person, if I had to build you a personification of who we're looking at, we're really looking at the low-end wage. How bad can the U.S. economy be when the bottom two quartiles of income are outpunching inflation, producing real wage gains in a way that we haven't seen for a very, very long time, and might I add, in a high inflation environment? So we just see it's very tough to produce bad circumstances in the economy. As an example, I was just up in Lake Tahoe. The Starbucks up there was advertising for $19.50 starting wage. That location's now closed because they can't fill the job. How bad can the economy be when you can make over $20, which is over $50,000 income a year at Starbucks? This is a great American economy, but it doesn't help wealth. Back to what we talked about with the asset managers and the wealth management business. That's not good for wealth. That crimps margins long term. That causes higher inflation, and that causes ultimately higher interest rates, hurting asset prices. The Fed is good at affecting asset prices. They're bad at controlling the economy, and that's why it's been a pretty easy bet to make.
Cole, this is how out of whack my inflation expectations are. I thought you were about to say it was a $19 cup of coffee, which
could very well have been true. Which could very well.
Yeah, but you still buy it, and I still buy it too.
I know that's the problem. Cole, we are the problem. But thank you so much for joining us. Cole Smead there, Smead Capital Management President. And we're going to be covering bank earnings throughout the afternoon and all week next week. Michael Santamassimo, Wells Fargo CFO, will be joining the Bloomberg Markets team at 2 p.m. New York time. This is Bloomberg.